Artificial intelligence has created more billion-dollar companies in just a few years than most technologies manage in decades. So why do so many ordinary investors end up buying in, only after everyone else is already celebrating? Every major investment boom tells the same story. At first, almost nobody pays attention. A handful of engineers, entrepreneurs, and investors quietly build something new, while the rest of the world looks the other way. Then the technology starts working. Funding pours in. Headlines appear. Valuations climb. Success stories spread across social media. Suddenly, everyone feels like they're watching history unfold in real time. That's exactly where we are with artificial intelligence. Every week seems to bring another announcement about record-breaking investments, trillion-dollar companies, or revolutionary AI products. The message is hard to ignore. The future has arrived, and if you don't invest now, you might miss the opportunity of a lifetime. But that message hides an uncomfortable truth. By the time most people become convinced that AI is the future, some of the biggest fortunes have already been made. Not because retail investors were too slow, but because they were playing a completely different game. Long before an AI company appears on a stock exchange, years before financial news covers its meteoric rise, and well before friends begin talking about buying shares, an entirely different world has already been placing its bets. Venture capital firms, private equity funds, institutional investors, founders, early employees. These are the people who often take the greatest risks, provide the earliest funding, and own significant stakes before the public has a chance to invest. None of that is unusual. In fact, it's how modern capital markets are designed to work. The real question isn't whether early investors make money. It's why millions of people only become interested after the story has already become obvious. Because once you understand how attention moves through financial markets, you'll realize that the biggest investment bubbles aren't always built on bad technology. Sometimes they're built on perfectly good technology, paired with impossible expectations. And that's where the real story begins. To understand why AI has captured so much investor attention, we need to go back to the moment artificial intelligence stopped feeling like science fiction. For years, AI existed mostly in research labs and niche technology circles. Companies invested billions into machine learning, but outside the industry, few people paid much attention. Then, everything changed. Suddenly, AI wasn't something hidden inside software. It could write emails, generate images, answer complex questions, and even help write computer code. Millions of people experienced the technology firsthand, and for the first time, its potential felt real. Markets reacted almost immediately. Technology companies announced massive AI investments. Startups attracted record funding rounds. Chipmakers struggled to keep up with demand. Every earnings call seemed to include the same two letters: AI. Investors didn't just see a new product, they saw the possibility of a new industrial revolution. And history gives them good reason to be excited. Electricity transformed manufacturing. The internet transformed communication. Smartphones transformed everyday life. Artificial intelligence could become another technology that reshapes entire industries. But that's exactly why periods like this deserve a closer look. When a genuinely revolutionary technology appears, excitement and speculation often grow side by side. The technology can be real. The opportunity can be real. Yet, expectations can still run far ahead of reality. Financial markets don't simply price what exists today. They attempt to price what might exist years into the future. That's where optimism becomes powerful. Investors begin asking not what a company earns today, but what it could earn a decade from now. Small improvements in those expectations can produce enormous changes in company valuations. And once stock prices begin rising, something fascinating happens. Attention follows performance. News organizations publish more stories. Financial influencers create more videos. Social media fills with screenshots of extraordinary returns. Friends begin talking about companies they had never heard of only months earlier. Success becomes impossible to ignore. For many people, this creates a powerful emotional response. Nobody likes feeling left behind. Watching others celebrate life-changing gains creates a fear that has driven almost every investment boom in modern history. Maybe this time really is different. Maybe waiting means missing the opportunity forever. That fear doesn't necessarily come from greed. More often, it comes from comparison. People see others moving ahead and naturally wonder whether they're making a costly mistake by staying on the sidelines. This is the moment when attention becomes its own economic force. As more people become interested, more money flows toward AI-related investments. Higher demand pushes valuations even higher. Higher valuations generate even more headlines. Those headlines attract even more investors. The cycle begins feeding itself. None of this proves there's a bubble. It simply explains why rapidly growing industries often experience explosive price movements. The important question isn't whether AI will change the world. It almost certainly will in ways we can't fully predict today. The more important question is this: who benefits most from that transformation? Because while millions of investors were just beginning to discover artificial intelligence, another group had already been funding the companies building it for years. And that's the part of the story that rarely makes the headlines. When most people think about investing, they picture the stock market. They imagine opening a brokerage app, buying shares of a public company, and watching the price move throughout the day. But by the time a company reaches the stock market, a large part of its financial story has already been written. Long before the public hears about the next breakthrough AI company, founders are pitching ideas to venture capital firms. These investors specialize in funding businesses that are still years away from becoming household names. It's a risky business. Most startups fail. Some never build a working product. Others run out of money before finding enough customers. Venture capitalists know this. They expect many investments to lose money. Their goal isn't to be right every time. It's to find the handful of companies that become extraordinary successes. Imagine investing in 10 young companies. 8 fail. One survives but grows slowly. The last one becomes worth 100 times what you invested. That single winner can more than make up for every other loss. That's the math behind venture investing, and it's why early investors are willing to take risks that most public investors never see. When artificial intelligence began accelerating, venture firms were already searching for founders building the tools, infrastructure, and software that could define the next decade. Money flowed into AI long before it became a daily headline. Private funding rounds valued companies at hundreds of millions, then billions, even though most people had never heard their names. At this stage, there are no stock tickers, no television commentators discussing quarterly earnings, no viral social media posts telling everyone to buy. The companies are still private. Ownership is concentrated among founders, employees, and early investors. Then something interesting begins to happen. As these companies grow, they eventually need more capital. They hire more engineers, expand into new markets, build larger computing infrastructure, acquire competitors. Growth becomes increasingly expensive. To fund that growth, companies often raise additional investment at higher valuations. Each successful funding round attracts more attention, not because the public can invest, but because the valuations themselves become news. Suddenly, headlines appear about another AI startup being valued at $10 billion, then $20 billion, then $50 billion. For most readers, those numbers sound like overnight success. In reality, they often represent years of development, multiple funding rounds, and thousands of hours spent building products before the public ever noticed. Eventually, some of these businesses reach another milestone. They become large enough to enter public markets. This is where many people assume the story begins. In reality, it's where one chapter ends and another begins. Going public isn't simply about raising money. It also creates liquidity. Shares that were once difficult to sell can now be traded on public exchanges. Early employees who accepted lower salaries in exchange for stock may finally have a chance to realize some of the value they helped create. Founders can diversify part of their wealth. Early investors can gradually rebalance their portfolios after years of carrying concentrated risk. None of this is unusual. It's one of the reasons public markets exist. They connect companies seeking long-term capital with investors looking for opportunities. But here's the subtle point that often gets overlooked. When a company reaches public markets, the nature of the investment has already changed. The earliest investors accepted enormous uncertainty. They invested before the business model was proven, before revenues became predictable, before anyone knew whether the technology would succeed. Public investors enter a very different stage. The company is often larger. The story is widely known. Analysts have begun publishing reports. Financial media covers every product launch. Millions of people recognize the brand. The uncertainty that once discouraged investment has largely disappeared. Ironically, that's often when excitement reaches its highest point. People feel safer investing because the company has already succeeded. But in financial markets, safety and price don't always move together. Sometimes the greatest uncertainty offers the greatest potential reward. Sometimes the greatest confidence arrives after much of the upside has already been captured. That doesn't mean public investors can't earn excellent returns. Many do. It simply means they're participating in a different phase of the journey than those who were there from the beginning. And once you recognize that difference, another question naturally follows. If everyone is discovering the same opportunity at the same time, what is it that convinced them to buy now instead of years earlier? The answer has surprisingly little to do with spreadsheets. It has everything to do with human psychology. Most people don't make investment decisions in isolation. We constantly look to the world around us for signals. If your friends are talking about AI stocks, if financial news covers them every day, if social media is filled with screenshots of massive gains, if analysts keep raising their price targets, it becomes increasingly difficult to believe you're witnessing anything other than the opportunity of a lifetime. This isn't irrational, it's human. For thousands of years, following the crowd often improved our chances of survival. If everyone in your village ran in one direction, stopping to ask questions wasn't always the smartest strategy. Financial markets, however, reward a very different kind of thinking. The crowd usually becomes interested after uncertainty has already begun disappearing. Markets reward people who are willing to tolerate that uncertainty before everyone else. That's an uncomfortable truth, because certainty feels safe. Imagine two restaurants. One has an empty parking lot. The other has a line stretching around the block. Most people instinctively trust the busy restaurant. Crowds signal quality. But investing isn't like choosing where to eat dinner. A crowded investment often means something else. It means thousands or even millions of investors have already reached the same conclusion, and every new buyer pushes expectations a little higher. The strange thing about markets is that expectations matter just as much as reality. A company can report incredible growth, launch groundbreaking products, dominate an emerging industry, and its stock can still fall. Why? Because investors weren't buying today's results. They were buying tomorrow's expectations. If everyone already expects perfection, even excellent news can disappoint. That's why experienced investors spend so much time asking a different question. Not, is this company amazing? But, how much of that greatness is already reflected in today's price? There is an enormous difference between believing in artificial intelligence and believing every AI investment is automatically worth buying. The first is about technology. The second is about valuation. Those are not the same conversation. History reminds us of this over and over again. The internet changed the world. That wasn't a bubble. Many internet stock prices during the late 1990s, however, became disconnected from what those businesses could realistically deliver in the near term. Electric vehicles transformed the automotive industry. Cloud computing reshaped enterprise software. Smartphones changed how billions of people live. Great innovations can create enormous long-term value. But markets don't move only on innovation. They move on expectations. And expectations can become wildly optimistic. That's where media enters the picture. Every headline competes for your attention. A story titled, "AI Company Delivers Solid Quarterly Growth," rarely spreads as quickly as one promising the next trillion-dollar opportunity. Social media amplifies the same effect. Algorithms reward content that surprises, excites, or provokes emotion. Optimism spreads faster than caution. Success stories travel farther than quiet analysis. Soon, an entire online ecosystem begins reinforcing the same narrative. The future belongs to AI. You need exposure. Don't miss out. Before long, buying AI stops feeling like an investment decision. It starts feeling like common sense. And that's exactly when every investor should become a little more curious. Because when an idea becomes universally accepted, the biggest question is no longer whether it's true, it's whether the market has already priced that truth in. This isn't the first time investors have believed a revolutionary technology would change everything. In fact, history suggests that revolutionary technologies almost always do. The real challenge has never been identifying the technology. It's identifying where excitement ends and unrealistic expectations begin. Because that's the line that separates investing in the future from paying too much for it. Here's the irony. Artificial intelligence may become one of the most transformative technologies in modern history. It could reshape healthcare, finance, manufacturing, education, transportation, and nearly every knowledge-based industry. None of that guarantees every AI investment will be a winner. History has a way of separating great technologies from great investments. The two are often confused. Railroads transformed America. Many railroad investors still lost fortunes. The internet changed the world forever. Thousands of internet companies disappeared. The lesson wasn't that those technologies failed. The lesson was that expectations grew faster than reality. That's what every major investment cycle teaches us. Technology creates opportunity. Human behavior creates bubbles. When prices rise quickly, people begin believing they're witnessing a once-in-a-lifetime chance to build wealth. Every new success story reinforces that belief. Every headline attracts new buyers. Every surge in price appears to validate the narrative. But markets have an interesting habit. By the time everyone agrees something is the future is no longer the surprise. It's the expectation. And expectations are expensive. This is why experienced investors often spend less time asking, "What should I buy?" Instead, they ask 3 different questions. Who already owns it? Why are they selling? And what expectations am I paying for today? Those questions don't produce exciting headlines, but they often produce better decisions. That brings us back to the idea we started with. The biggest fortunes in AI weren't necessarily made when the public became convinced. Many were built years earlier, when the technology was uncertain, the risks were enormous, and the outcome was far from guaranteed. By the time AI dominated headlines, billions of dollars had already flowed into startups, infrastructure, semiconductor companies, and private funding rounds. Public investors weren't entering at the beginning of the story, they were entering during a different chapter. That doesn't mean they've missed every opportunity. Far from it. Artificial intelligence is still evolving, and many companies may continue creating tremendous value over the coming decade. But understanding where you stand in the investment cycle is just as important as understanding the technology itself. Buying a great company at an unrealistic price can be just as risky as buying a mediocre company at any price. That's why successful investing isn't about chasing the loudest story. It's about separating excitement from value. The next time someone tells you that AI is creating the next generation of millionaires, don't immediately ask which stock they're buying. Ask a different question. That single question can reveal more than any viral investment tip ever will. Because markets don't reward people simply for recognizing a trend. They reward people who understand timing, expectations, and risk. And that's the difference between following a story and understanding the system behind it. If you enjoyed this deep dive into the hidden mechanics of modern markets, consider subscribing. Every week, we break down the forces shaping the global economy, financial markets, and the technologies changing our future. And if there's another financial mystery you'd like us to explore, leave it in the comments. Thanks for watching, and I'll see you in the next one.